Hey everybody, good day. Welcome to another episode of Stock Talk, where we talk all things investing. And my name is Amin Reina. I'm an investment coach here at Sage Investors. And today it's Friday. I thought I'd just babble about some random market observations I've seen from the week and throw my little takes into them. A couple of things I've noticed for this week. I guess one big thing is that we seem to have come across a bit of a game changer moment, in which is essentially involving the impending flip-flop by the Federal Reserve on the whole concept of interest rates. So for those of you just joining in December, the Federal Reserve, for the first time in a whole whack of years, decided to increase interest rates, and that was a bit of a game changer moment in that sort of the momentum now had changed, and the general idea was the economy is moving a little bit better, the U.S. economy is moving a little bit better, and so it's time to normalize interest rates. And so December seemed to be marking that first point into a trend of rising interest rates, and a lot of people thought that would be not a great thing for stocks, and from that perspective, I personally thought it was long overdue, because the whole concept of risk has just been eliminated in the market, and assets and stocks and land and property and a lot of things out there in terms of assets have been essentially overvalued. So I thought that move in December was a good move. So then what do we have? Then we got into January, and then everybody knows what's happened with stocks. Stocks have basically tanked throughout the month of January. Lots of pain, even though marginally it wasn't a crash. There wasn't any significant crash, but it was a pull down, and the sentiment had just gone incredibly negative on stocks. So what happened this past week? So the Federal Reserve had to go up to Congress and testify and comment a little bit about some of their moves and their observations of what they see. And it's interesting. And also they had to put out their Fed minutes from their last meeting. And it's interesting, in that meeting, they commented that they really had a hard time making that decision to increase rates in December, because they were looking at the data, and they're data dependent, and saying, oh well, interest rates, the economy, it's not that great. It's not as going on as gangbusters, and it might get a little bit worse. But they went ahead, they plugged their nose, and God love them, they tried, and they went ahead. And it seems like there was a lot of hand-wringing and a lot of second-guessing going on, and a lot of doubt going on in the Federal Reserve, whether that was the good move. And so now all of a sudden the body language and the vibe that we're getting now is that maybe we will just kind of revisit this whole strategy we had for increasing rates. And it seems like the stock market kind of really has, again, influenced them. This happened last August. It had the same mentality happen and attitude, and now we're seeing the same thing. And it's kind of concerning, because the Federal Reserve is not there, the mandate is not there to keep stock prices up. They're there to ensure that there's enough liquidity in the financial system, ensuring that prices are stable. That's kind of their mandate, really. Their mandate is not to prop up asset prices. So it seems like they got kind of rocked a little bit, and now they're kind of talking things down a little bit, trying to talk down the rhetoric of increasing interest rates. So great. So what does that mean for investing? So the biggest impact is if they start to basically stand pat with interest rates and just don't bother increasing them, or they actually cut. And there's been talk, and I've talked about the whole concept of negative interest rates out there. There's been talk about that. That's been thrown out there. If it goes that way, what's the big impact? Well, the big impact that I've been talking about is currencies, and that would be the U.S. dollar. So if interest rates stay flat or go down, then the U.S. dollar, which has been surging and has been a pretty big reason why commodity prices like oil and copper have been tanking, besides the supply-demand equation, but that's been a bit of a has provided a little bit of a goose, a little bit of a gas into, excuse the pun, in terms of oil prices falling. Well, we could see a U.S. dollar starting to really tail back a bit, and if the U.S. dollar tails back, that's really going to put upward pressure on commodity prices. And so everybody's worrying about. It's interesting. Barron's talked about the era of sub $20 oil. Well, you know what? We could be going back to $40 as far as we know, if the trend now is for the U.S. dollar to weaken. Now, the flip side of a weaker U.S. dollar is also it makes U.S. products and services a lot cheaper. So when they're going out in the world and competing, U.S. companies are competing, they can compete a little bit more effectively on price, and that's going to allow them to increase revenues, allow companies to increase revenues, increase profits. That's good for stock prices in the long term, in the medium to long term, so profitability. So it's interesting that in January we were in a I was personally in a console where, you know what, I don't think I want to start looking at buying stocks. And now all of a sudden the Fed is deciding to take an episode from Back to the Future and go back to what life has been like for the last 2 years, or last like 6-7 years, with ultra low interest rates, and basically just trying to keep that party, reigniting that party. And to me, I think that's a backwards move, and I think in the long term it's just going to inflate assets even more. But if we're going to go back to this inflating assets kind of thing, and ultimately it's just going to make that adjustment that's going to have to happen sooner or later, it's just going to be a hell of a lot more painful. So I thought it was a bit of a game changer moment. So my mindset now in January was like buy stocks, and I did buy stocks. If you go on my blog and you go on my website, you can take a look at what I've done. But now it's like, whoa, I think I want to hold back. I think now I just want to sit back, and because I think the party train, that money printing party train, is probably going to start up again. So that's one big observation I saw. The second one is this whole dynamic where I'm hearing about it was with respect to oil prices, talking about how oil prices and stock prices are kind of like going up in hand, and it's just such a weird environment we're in, that people want oil prices to go up because it's going to help stock prices. And to me, that's really short-term thinking. And I think the reality, what the reasoning behind it is, just people are looking at it from the short-term economic impact, because lower oil prices is forcing a lot of companies to cut down on capital spending and investment, and which is a significant driver of economic growth. It has been in the last 4 or 5 years. So people want oil prices to come up so companies can keep going and drilling and hiring more, getting people back to work. So I think that's a short-term concept. And the other side of it is the financial system, because there's been so much money lent out to oil companies that are just now starting to curtail consumption. And the worry is just people are just worried that some of these banks are just loaded too much on debt. I've loaned out a lot of money to these oil companies, or some of these oil companies, especially the junior exploration kind of companies, and they're just worried that there's going to be a lot of people just going to be walking away from those loans and just going bankrupt, and that's going to create the stimulus for a potential, financial crisis part 2. So, but I think that's really short-term thinking. The thing is, oil prices, if they can be low, are good from a consumer perspective, because it just makes us easier. We're just going to have more disposable income. Instead of putting all our money into our cars and filling them up, we're going to have more extra money freed up to consume other things that are important to us. And ultimately, if we're consuming more, that's good for companies' revenues, profits, stock prices. And so I just find the dynamic right now of people, analysts rooting, like literally cheering for oil prices to go up, from a consumer perspective and a long-term economic perspective and a long-term investing theme perspective. I just find that really hard to, it just doesn't make sense. And so it just tells you the nature of the market, how really whacked out it is right now. It's just, the logic just doesn't seem to be there. And yeah, so I thought I'd just share a couple of those observations with you. If you have any questions, you can feel free to give me a shout at DM me on my Twitter account at Sage Investors. I comment a lot on the various market happenings and my own investment decisions that I make, the thought processes that I work into my investment decisions. I tweet them out. I tweet all my investments that I make on real time, so check it out. If you ask me any other questions about coaching, investment coaching, and stuff like that, you can hit me up on my website, send me an email. My website is www.stageinvestors.ca. So that's another edition of Stock Talk. Hope you enjoyed it, and we'll catch you again. My name is Amin Reina from Stage Investors, and yeah, we'll have a good weekend, everybody. And we'll see you next week. All right, take care.